Afternoon, you've tuned into MF Corner on CNBC TV18. I'm Vinny Motiwala. With me is Sonal Bhutra as well. Sonal, very good afternoon to you. Momentum currently in the markets is not exciting, but momentum funds in the last couple of years have done quite well. And that's what we're going to be talking about.
We are going to be talking about that and focus on whether it is the time for investors to go ahead and invest in momentum funds or not. These funds have witnessed a remarkable journey actually, with their assets under management growing from just 2,400 crore rupees. This is in December 2022 to a staggering 20,742 crore rupees. This is as on June 2025. However, these funds have seen a sharp decline of over 20% in the last 3 to 6 months. So, do these funds thrive only in the bull markets? What is the stock selection process? Who are these best suited for in terms of investments, in terms of their portfolios? To get these answers and more, we have Harsh Roongta, founder of Fee Only Investment Advisors, and Shweta Rajani, who is the Associate Director and Head of Mutual Funds at Anand Rathi Wealth, joining us now. Harsh and Shweta, thank you so much for joining us today. Lady, let me start with you first up. In simplest terms, let's make it easier for our viewers. What are momentum funds?
Good afternoon. Yes. So, momentum, just like the name says, if I see in simple English, what momentum means is something that is running too fast in a certain direction. And when you apply that in the investment, philosophy, then it is talking about stocks that have been running in a high direction, which means stocks which are seeing their prices rising in the recent time period. And therefore, when I say a momentum fund is investing in those stocks which in the recent period, which means in the last 6 to 8 months, 1 year, may be running high prices and seeing good returns. And that's where momentum funds invest in.
Okay, where there is some bit of a trend, that's where that momentum fund investment comes in. But Mr. Roongta, I would come to you with the same question as well. Anything you would want to add on that front, as well as in terms of momentum funds? Recent times, we have seen that decline coming in, specifically in the last 3 to 6 months, right? So, which have been the worst performers, and how volatile are the returns in these funds, and how careful does an investor need to be after this?
I think she's explained what momentum funds mean very, very simply. I mean, it just follows the basic maxim of stock markets, right? Bhav Bhagwan che. Price says everything. It encompasses all fundamental analysis within itself, and definitely it does so over long periods of time. The only thing I want to add are basically two things. One is that these funds will be very volatile because it follows prices, and prices are volatile. Any investments based on prices is bound to be very, very volatile. And over time, and time I mean literally like over 8 or 10 years, over time, if you follow this trend on a very disciplined basis, it in the past has made money. Now, two things there. If you just look at short-term periods, you spoke of a 3-6 month period. We've not even done an analysis over 3-6 month period. But if you do an analysis over a 1 year period, and if you look at the various momentum funds, pure momentum funds today come in 3 varieties that you invest in, where the universe is, the 200 stocks, either Nifty or BSE, or the universe is the mid-cap 150, or where the universe is 500. I think these are the 3 universes on which there are momentum stocks that is available. 30 out of the top 200, 50 out of, the mid-cap 150, and 50 out of the 500 stocks.
Okay.
Now, in that, absolutely. But in that, please note that over a 1 year rolling period, going right back to 2011, there are at least 20% of the time, and sometimes up to 25% of the time, the 1 year returns of momentum funds lag the, underlying wide index. Second thing is, people also tend to misunderstand overperformance. Now, if an underlying fund has dropped 15% and the momentum fund drops 5%, it still got a negative return, but it is counted as an outperformance. So I think these two things. One, that momentum funds are very risky. It is only meant for that portion of an investor's fund that is for long term, meant for high risk. And second, that it will deliver relative outperformance, not absolute positive returns. And over short run, like a year or 6 months, 3 months, it's not relevant. So I think the statistics quoted have no relevance at all. And those people who are going to look at 3-6 months returns to decide should not be investing in momentum funds or any equity funds for that matter.
It's the long-term game, right? We've been talking about that. In fact, Shweta has very helpfully put out that table as well. That should come up for you on the screen. It talks about and compares it to in various time frames, be it 3 months, 6 months, which both of you have said we should not be looking at in general. But even 1 year return has declined 10% for momentum funds versus a time when Nifty was up around 1.7% and Nifty 500 is up 4.43%. So that graphic plate should also come up for you on the screen. And this is something that indicates how returns have been over a period of time. 3 years though, it's been up 20%, while Nifty is up 14% and Nifty 500 is up 17%. So this is something that Shweta has provided us in terms of returns as well. So Shweta, let me come to you in that case. So do momentum funds only thrive in bull markets? Then how does one get an idea, right, when to enter such ones? How does the entire process work here?
Sure. So, like we've seen the data also historically that if I break it up, into calendar years or financial years of a year, and then you see in how many instances have momentum done better than a broader market. Yeah, you would see that if I'm looking at the last 7 calendar years, then probably 4 out of those 7 years, momentum has done better than a broader index. Now, those were also years where the broader market did phenomenally well, I would say, whether it was your 2021, 2023, and if a broader market is giving 25% or 20%, which itself is very good, you have most of the stocks running up. And what you should also look at is this during this time period, it's not only large caps that have done well, but mid and small as well. So it was that phenomena or that phase of the market where whatever you were touching was gold. So it's but natural that you could see momentum doing better in those periods where the broader market is performing well. However, this also comes in with a far more volatility, because of that same 7-year chart, if you see, the ups and downs are way more volatile in a momentum index than a broader market index. So one thing is clearly, if you have to look at momentum, look at the risk adjusted return and then see if it makes sense for you, which in my in my analysis, what I have seen is in most cases it may not make sense in all bull year periods. So while one check that you have to do is, yes, it's a bull market, so momentum as a factor may play out better than the other factors that you have of value, quality, all of those. But also you need to check that are the broader market caps also doing well, because rather than being in a style which is momentum, breaking it up into a diversified style but having more of a mid-small exposure may make more sense for you than focusing on one factor. So that's one thing. Yes, bull cycle means a high probability of a momentum doing well, but there are other factors that you need to look at. Second, like I said, if you're looking at those trigger points, look at the risk-adjusted return. Look at your expectations from not just a large cap segment, but also what you could expect from a mid and small cap segment, and then take your decision.
Okay, important factors there that one should be keeping an eye out on before deciding in terms of the momentum fund and entry that comes in over there as well. Mr. Roongta, what about the stock selection process in such a case as well for such funds? Is it fundamental or technical? And also in terms of any other points that you would like to add on when one should be looking at entering these funds or factors that one should keep an eye out on?
I think, as Shweta ji explained right in the beginning, momentum funds assume that the price encompasses everything. and therefore all the funds that have done well over a stated period, typically it's 6 months, then the funds that have generated the highest return from a given universe, whether it is 200 or whether it is mid cap, whether it is 500, from that universe, the top 50 or the top 30, whatever be the ultimate selection, those are ranked and it's called a Z score. And on a certain basis, because they will keep certain more number of stocks than what they are going to finally select, there is some technicality around what will be the proportion of each of those stocks. So, but within that, I think the real thing is, as I said, it is based on returns. There is no fundamental, there is no technical in that. The other thing I think very important for, and you asked about who should be doing it and whether this is the right time. Anybody who's going to look at last 3 months, 6 months returns to decide whether to invest or not, no factor fund, forget momentum, no factor fund. In fact, no equity is good enough to invest. You can't look at 3, 6 months, 1 year's return to decide on whether to invest in a particular scheme or not. Second, I don't think we should look at an investor as a whole. Every investor, no matter how aggressive that investor is, to the extent that there is a part of his wealth that they are going to use for the, say, child's education that is due in the next 1 to 3 years. Now, that cannot go into 100% equity. No matter how aggressive that investor is, and no matter how conservative an investor is, if the money is needed 30 years later or 20 years later, some portion will go into equity. Whether that equity portion can go into even more aggressive portion of that equity, which is factor investing or not, is a matter of individual choice. But what I'm saying is that, and we don't look at an investor as a whole. We look at that portion of the investor's wealth that is earmarked for usage after 8, 10 years at least, and which can be allocated to very high risk investments, and only those should be considered for things like momentum investing.
We take that point, makes a lot of sense, and talks about the basics of investments, right? Not just a particular theme, not just a particular particular category, so to say. Very interesting discussion, but we have to slip into a quick break. We'll continue our discussion on the other side. Stay tuned for that.
Welcome back to MF Corner on CNBC TV18. We still have with us Harsh Roongta, founder of Fee-Only Investment Advisors, as well as Shweta Rajani, Associate Director and Head of Mutual Funds at Anand Rathi Wealth. While we're today discussing on momentum funds, and we've discussed so far what are the funds, when do they give the best returns, what are the factors you should keep an eye out on while investing in these funds. Now let's talk about how does it change things for an investor when you invest in passively managed momentum funds and active managed funds. Shweta, what is the difference between that, and how should investors actually be evaluating this factor?
Sure. So, when we talk about a passive fund, now clearly it is investing in an underlying benchmark, and the fund manager is not intervening or, calling the shots over here. Now, what happens is, let's say for a momentum index, the index will change its constituents or rebalance the portfolio once in 6 months, and which generally happens in June and December for a lot of these momentum funds, which means that what would have recently happened may not be captured in the underlying portfolio of the index constituents. So the changes that may be requiring an immediate attention may come with a lag of few months. And therefore, when you're investing in a passive fund, clearly there is a possibility that you've missed out on those active calls, and there's no risk management that is getting applied over here. So your risk may be more, plus you may be compromising on the returns a little due to active calls not being taken. On the other hand, in an active fund, clearly, you can decide your weightages to stocks. You can decide if for a certain stock, a momentum is not playing out. You don't have to wait for a 6 months period. Every month, you may want to churn a little bit of your portfolio. So that higher active management clearly could yield a slightly better return. And in fact, in momentum funds also, if we go to see why there are 27 schemes today, there's one fund which is the Samco actively managed momentum fund, which has completed a 1-year period. And if I look at that fund and compare it to the passive momentum funds itself, it shows that the Samco fund has done slightly better in terms of return, also at risk levels lower than that of the momentum index. However, the second part to this is also investing in actively managed funds which are more diversified in their style. And that could have a blend of, momentum, quality, all of that. And then if you compare that third leg, that shows that those actively managed funds have done better than actively managed momentum fund and far better than a passive momentum funds. So that's, the key differential. What you should do is maybe, look at funds which have a momentum play, but also is not completely dependent on a momentum play, and be in the active space.
Got that point, Shweta. Mr. Roongta, coming to you. In that case, you have spoken about it, but momentum funds in that case are only for investors who undertake high risk. What would the risk profile for such investments be? And is it a good time to look at momentum funds, if at all?
As I already mentioned, it is not dependent on the risk profile of a investor. Each investor for different portions of his wealth. I mean, in technical terms, we call it asset allocation, right? For the different parts of his wealth or their wealth, they are basically going to have different objectives. On some part of the wealth, they can take high risks. On certain parts, they can't. So I think that needs to be sort of recognized. For any long-term investment, whether it be in, just pure simple equity funds or, in even more high risk, factor funds, and probably in factor funds, momentum is the riskiest. Whether to do that in that or not will depend on, how much that portion has been allocated in this particular for that investor. And timing, I think, should be absent, because when you're doing an 8-10 year investment, when you get in is hardly going to be relevant at the end of 8 or 10 years, and data supports that. It has very little weightage. The key there is to stick to it. Very, very clearly, during short terms, it may underperform the broader indexes. If you get out at that time, the strategy will fail. It's not primed to do that. So I think that is extremely important to sort of remember. And I think if you remember that why have you got in? You have got in because you had an 8-10 year horizon. You were prepared to take high risk. And if something is not working out, during 6 months, 3 months, 1 year, 2 years, then that is how that strategy is designed. Please just be aware. And if you're not aware, don't get in. As they say, if you can't stand the heat, don't get into the kitchen.
Okay, get that point, Mr. Roongta. It makes a lot of sense. So far what we've understood on the conversation is momentum investing is, and it's something that works for these funds when market is in a bull market, though for a longer period of time, these funds have not really given superior returns to the benchmarks as well. In fact, if we talk about the data that Shweta helpfully provided us in terms of the returns, that should come up for you again. It is over a 1 year period that these funds have seen a decline of 10%, which compares with Nifty gaining 1.7% and Nifty 500 gaining 0.43%. And as Mr. Roongta said, it's not very particular to an investor, and it is not something that should be the core part of your portfolio as well. So makes sense. Shweta and Mr. Roongta, thank you so much for joining us today with your take on what momentum investing looks like and who is it favorable to, and what should be a part of your portfolio when it comes to momentum funds as well. It was a pleasure speaking to the two of you.
Thank you.
Okay, with that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.